All right. I know folks are starting to join us. We're going to give people probably 2 minutes to join us, just because to join the room before we get started. While we're waiting, please let us know where you're joining us from. I'm on the East Coast. Very rainy today. Christopher, I assume you're on.
I'm out in beautiful San Francisco. It's always sunny.
It's always sunny. It is. I do miss that about San Francisco. It's always a nice 60 degrees.
Right. It makes you soft. It makes you soft living in this environment.
Yeah. I remember when I moved to Miami after San Francisco, and then when I moved back to when I moved up to New York, first winter was rough.
No, but that makes you right. Like that keeps it real. In San Francisco, we're all just kind of lackadaisical, whatever.
Yeah.
Always
you just need sweaters. Jackets don't exist.
That's right. Yeah, and just in the summer.
Yeah, just in the summer. I think what is that? It's a Hemingway quote. Is like, what's the? He's just like,
I think that's apocryphal, right? Mark Twain, right?
It's like, it's the nicest summer was like my winter in San Francisco.
Exactly. The coldest winter I ever spent was the summer in San Francisco.
Oh yeah. I'm switching it around.
I think it's totally apocryphal. You never said any of that.
Yeah.
It's true.
Perfect. So we're going to get started. So today's going to be a fun discussion, and it's going to be a little less on the basics. It's going to be really understanding QSBS eligibility and maximizing your QSBS benefits. And really, I'd say probably more focused on the latter half of maximizing your benefits. What are the gray areas, and like what are the real opportunities this is candidly for anyone in the tech space, this is probably the best tax break around, the most useful thing you can understand from a tax point of view. And we're really going to be focusing on maximizing your QSBS benefits. And really who's going to be driving that is Christopher. I'll give a quick introduction to yourself and then let you go deeper. But you're probably the go-to expert for QSBS, which is Qualified Small Business Exemption. And you're the go-to expert for people to understand, does this work for this company that's in a gray area? Or kind of how many exemptions, or how can you maximize this? Or what are kind of the interesting opportunities that may be available as to, the thing about tech is we're always pushing boundaries. There's always kind of new gray areas where the law wasn't built to describe, this fintech company or this medical device company. And when people have those questions, you're the kind of go-to person. Do you want to give a little bit of background on yourself?
Yeah, that's what Manny says. So I'm a tax attorney based in San Francisco, and I just happened to be at the right place at the right time, right? In 2015, 100% exclusion came online for QSBS. We're going to go through all this stuff. And the people in Silicon Valley, the sort of founders in Silicon Valley were the first people to kind of realize the benefits. And I had been publishing and writing. And so it's been super fun to kind of see, we're now 10 years into like this QSBS benefit, right? And to see how, it went from a few small tech bros who understood it. Now, there's people everywhere who are starting to see it and take advantage of it. So I'm honest to God, I have the best job in the whole world, right? Because every day I get on the phone with cool, interesting founders who have built really impressive businesses, and our job is to help kind of think about why is it QSBS, why is it not, and how to maximize it. So, and what's awesome, all the founders are super smart. They just kind of need to like think through how to approach the problem. Right? They're like, hey, it's like I code the Internal Revenue Code, I can figure it out, right?
I mean, so I have to say, this is how I ended up in the space and starting Valur. So I started Valur. I worked for a startup. It IPO'd. I lived in San Francisco. I lived, previously in San Francisco. Joys of beautiful weather, downsides of the high taxes. And for me, COVID hit. Was looking at the startup back when I was like, hey, I've read these stories. Honestly, probably a lot of clients that have worked with you. And I was like, seems like they figured out how to minimize taxes in a legal way. Why don't I try to solve this? Yeah. Same logic. And I went down the rabbit hole. You realize it's a fairly complicated space. It's very opaque too, which is part of the challenge. So my kind of vendors solved it for myself and ended up building Valur. The whole idea is how do we bring transparency to the space through seminars like this, content, tools, really help people understand what are these tax mitigation tools that your clients and people that are building, kind of value in this world use to minimize taxes and make it easy to access and take advantage of. So really today, we're going to start with some basics of what is QSBS and then kind of jump into more some of the general and special QSBS rules and really focus on some of those gray areas. So it's, there's which companies, where is that, where are those gray areas, what companies apply, what we've seen from kind of IRS rulings, and really how to maximize these benefits with QSBS stacking and various other options. And then we'll also leave some time for Q&A at the end. But I have to say is if you have questions, please share them during, add them in the comments area, and we'll try to address them as close to real time as possible. So let's get started with basics of QSBS. And I'll just, QSBS, this is probably the best tax break around, as I mentioned, for people in the tech space. You can, at the federal level, avoid capital gains taxes per taxpayer on up to $10 million per company, or 10x your investments. If you founded the company, that's 10x your basis, which is typically almost zero. Now, critical piece that's doing a lot of work here is per taxpayer, and we'll get to what that means later. Anything that you think is important to call it at a high level here?
Well, I mean, like this is super important, right? Like, and it's not just federal, right? In certain, like in New York, if you sell shares of Microsoft, right, you pay 23.8% feds, you pay whatever, like 8% New York State, and then you pay New York State local tax, right? Like your effective rate is like 35%.
Yes,
right?
35. As a recent transplant in New York, it is 35.
Yeah. Right. And with QSBS, if those shares are QSBS, you pay zero fed, zero state, zero local in Manhattan. It's remarkable, right? Like out here in California, we used to have a conforming QSBS statute, but there's a lot of states where you avoid it. It's not just federal, but it's state as well. So
key piece there is 45 out of 50 states also follow the federal guidelines. So what you're saying is what you call that in New York is in 45 out of 50 states, you are paying zero taxes for the federal and state level. Now, probably the most prominent one that doesn't is California. But the good news is, you're paying your 13% tax on your gain instead of 35%, but it's still pretty good. Now, kind of high level again, who's this for? Entrepreneurs, small business owners who are raising capital, selling their business, venture investors, and early employees of these companies, right? Like this is, and how would you define the group of people who are eligible for this, from an industry perspective, Christopher?
Oh yeah, well, I mean, we'll get into what companies are qualified. I think what's important about, we'll talk about the $50 million aggregate gross asset. You got to get in before the company has 50 million. But what's important, if you go back to the legislative history to QSBS, right, from 1993, it says we want to give people this tax benefit because most startups fail, right? In other words, if you get in early, right, you're going to get this benefit because you're taking that risk, right? Yeah. And so, from the founder's perspective, it's kind of like a foregone opportunity. I could have gone and worked, I come out of Stanford Business, I can go work for Bain, or I can, live on ramen noodles and max on my credit card and build this cool thing, right? The fact that I decided to forego that opportunity, that's a proxy for that kind of risk, right? Same thing for the VCs, right? The VCs are investing in all these startups and early employees, right? Like the guys that get their stock options and early exercise, they're taking risk too. And so I think when you think about who gets QSBS, the real question is, are you taking risk, right, in this startup that in all likelihood is going to fail? But if you make the moonshot and it works, right, you get that tax benefit.
Yeah, and I think that's a really important point is it's compensating for risk. And there's also a broader point is, right, what this is fundamentally trying to say is, hey, there's risk, but this innovation, this is, right, what really differentiates the United States as an economy is innovation, right, risk-taking. And the whole idea is, when you look at NVIDIA or Google before that or Microsoft, the U.S. has, the industrial age before that, Ford, the U.S. has always been on kind of the cutting edge. And that's what really puts us in a really economically powerful position. And what this is trying to say is, hey, obviously the risk capital, the time people put in has benefits, but we actually want more capital, more talent, more people to take that risk. So how do we increase that upside? And so it's
people say QSBS is this giveaway, there's that New York Times piece we've talked about that it's a big giveaway, but it's not there's good policy justifications to give this award to people who take that risk.
Yeah, and it's been a historically bipartisan because I believe it was originally passed under Clinton, if I'm remembering
Yeah,
correctly.
1992 is when it came in. 93, 92 is when it came into law. So right under Clinton, and then
And it was 50%. It was originally originally what it was you could avoid taxes on 50% of your gains. So it was, half the tax rate effectively on your QSBS eligible assets. And then I believe it was Bush who increased it from 50, correct me if I'm wrong, from 50 to 100%.
Yep. No, yeah. No, actually, it was under Obama that it went to 100%. Right. So 2000. So between 1992 and 2009, it was 50%. In 2009, it went to 75%. And then if you get shares of QSBS after September 28, 2010, under Obama, right, and you held them for 5 years, you get 100% exclusion. So it's definitely bipartisan. And in fact, the 100% exclusion came in under Democrats.
Yeah. So, and this is the thing is, innovation's generally been a bipartisan thing that we all want to encourage, leads to better jobs, more opportunities, and kind of economic power for the United States. Now, maybe we want to run through, I don't know which of these kind of, here's the general qualifying QSBS rules. I want to run through kind of what you think is important here for folks. That are there particular rules that you think are, I think the obvious ones I've seen are, we talked about the 10 million or 10x your basis, but maybe they kind of want to add more a little bit about the qualified use of assets in small business.
Sure. Well, let's go through each. Original issuance is super important, right? Because each of these bullets kind of covers an important fact. One is that you got to get shares of a domestic C corporation at original issuance, right? So and original issuance means in exchange for cash, property, or sweat equity. So if you get units of an LLC, that LLC could convert into a C corporation under the right circumstances. You start your QSBS holding period then, right? But an LLC doesn't count. S corporations, we see folks all the time who are super nice founders, and they started out and they talked to their uncle in Ohio who's a super nice CPA, but doesn't know anything about QSBS and said, make the S selection. Those guys are boxed out.
Seen a lot of that, yeah,
boxed out from QSBS, absent like an F reorg to reorganize. So you got to get shares of a domestic C corporation. If you get, and the same deal, we see a lot, I get on the phone and it's an Australian founder and we're talking about QSBS and I'm like, okay, in 15 minutes, I'm gonna have to break this kid's heart, right? Because he got shares of an Australian company and then the flip into the US, right? So he never paid for US domestic C corporation shares, right? And I'm like, I'm sorry, you're $80 million of stock. It's not,
he's not gonna be eligible.
So that's it. So you got to pay for shares of a domestic C corporation or contribute assets, right? That property, right? Contributing property, that's super cool because that gets you into the 10x, right? Like, let's say I contribute IP into the C corporation of 7 million, right? 1202I says when I contribute property, that IP into the C corporation, my basis is set at 7 million. I can exclude 70 million. Right.
Yeah.
Which is remarkable.
And this is to the kind of the fabled example is you start the LLC because the company's eligible if it's less than 50 million assets. The company gets valued at 49.9 million as an LLC. You convert it to a C corp, and then so to your original issuance, you're converting essentially the assets of the LLC in exchange for you're converting to a C corp, and then your basis is 49.9 million, and so your QS eligibility is 10x that 49.9 million, or effectively $500 million.
So every single founder in Silicon Valley is walking around with an LLC, just assuming he's going to convert at 49.99999. Every single one of them.
Yeah, the funny part is, I don't know if this is funny, but a lot of it is people do there's a lot of planning, and it's the nature to the earlier point, these things are so hard and so risky that it's, the hard part isn't that it's building the company that becomes worth that $500 million is the real challenge. Now, there's an interesting
and you don't have to these are all super technical. You don't have to oversolve. Typically, a normal founder, who sets up a Delaware C corp, gets his restricted stock, files the 83B, and starts rolling and going out to get VC funding. All of those, that all works, right? It's you're certainly able to get to the QSB. You don't have to do anything special, right? If you're just starting out and you want to roll out.
Yeah, your job at that point is build a company that creates value, build something valuable, and that's the one thing that matters. Now, maybe we talk about the small business and kind of holding requirement. And like, what does that
Yeah,
entail?
so that's in general what the rule says is you got to get the shares at original issuance before the company has more than $50 million of aggregate gross assets. And that's just an arbitrary ceiling that Congress put in place, that which basically means like once the company has raised more than $50 million, it can't issue any more QSBS, right? So like the founders definitely get that. The early employees who exercise, they get it. The Series A investor, the C, the B maybe, right? But once the company has more than 50 million, even in the round that you go over 50 million in raising that capital, the company can't issue any more QSBS after that. Now, all the QSBS that's already been issued retains its QSBS, right? It's just that once the company has gone over that 50 million, it can't issue it. Because that's like where Congress drew an artificial line to say, this is what small means.
Yeah.
Right? That once you have,
and there's no inflation in this number. The 50 million is a hard number. There's no inflation now. And there's also this piece of there's also this piece of they want you to invest time, and so that you have to hold these shares for 5 years. Now, there's a couple of interesting nuances here. So one, let's say you're an early employee at the company and you receive the shares, and let's say you been in company for 5 years, but you only exercise the shares 3 years later. Yep. Are your shares are QSBS eligible? Let's assume they were eligible, but because you exercise them 3 years after you joined, so they've only been exercised for 2 years. Would those shares qualify at that 5-year point?
No. You got to exercise the shares and get stock. So the legislative history says options, warrants, and convertible debt can be QSBS, but only on conversion. Right. So I have calls with kids, early employees are like, yeah, so I've got all this QSBS. I want to do stacking or whatever. I'm like, okay, so when did you exercise your options and get the shares? They're like, oh, no, it's still all options.
Yeah.
And I'm like, no, dude, I'm terribly sorry, but that doesn't work. So that's because, again, think about it like from a policy standpoint. The point is, if you early exercise and get the shares, that's actually risk, right? You're paying for the shares. You're holding shares, right? So
yes.
This is also relevant for investors, right? Because there's an open question about whether safes, right?
Yeah, this is a great one.
You know, the sort of loan investment tool in Silicon Valley now for early investors to come in is the safe.
Yeah, and just for
simple agreement for future equity that says, well, you're making this investment and this instrument will convert to shares, but the question is, does that safe start the 5-year holding clock or not?
Yeah, and just for context, right, the safe is kind of, it's been around for a while. YC really made this the default standard. And there's a lot of reasons of, it made things simpler for investors and founders, really cut out a lot of legal work that was involved up front, for particularly when you have a lower amount of capital that you don't require. And this is why historically people did price rounds of these, the bills are typically 6 figures or more. And just for an early stage company, that's just a lot. Now, the piece is this is debt, which is why it's not a security. So then you get to cut out a lot of the legal work. And the piece is
there's a greater right. It doesn't attach a price to the value of the company. Like it's an elegant solution to early investing.
Now, and there's the gray area is like, does that start the holding clock? Now, I will say, and I'm curious to what you see. I see the default is almost every investor I know starts it from the time they make their safe. When they invest the safe. I'm curious as to kind of what do you see or what you see.
Yeah, well, that's like the working assumption now, right? But and this is important because the YC safe, it says for purposes of 1202, this instrument is QSBS. It's stock for QSBS. But I can say, hey, Manny, like this is like, hey, for purposes of this call, this is an Android phone. Right? It doesn't make it an Android phone.
That is my favorite legal notice additions. Is just like, for the purpose of this use case, I deem this like it's like
right. For purposes of this webinar, Christopher's actually a competent attorney, right? Like that doesn't make me a competent attorney. But like joking aside, I think for a long time people were super worried that the safe didn't create holding period. And given that language I mentioned from the legislative history, right, saying that convertible notes, warrants can convert. But increasingly, I think people are getting comfortable with the safe creating QSBS holding period, and I think it's true because like the kind of ecology of early early investing now is like safe is the only way you can do it, right? The whole point of QSBS, we talked about, the legislature says we want to incentivize people to invest in early startups so they fail. If the only way I can invest is through the safe, that's kind of like it makes it. That's what I could go to some guy and say, hey, sell me price shares so I can get QSBS. They won't sell it to me, right?
Yeah.
So I think
totally.
but it's an open question, right?
Yeah, there's a question here, and I think you kind of addressed this. So Alfred's bringing up: is there a time frame before a sale where you can convert from an S corp to a C corp?
You can convert. Like if you, let's say you start as an S corp, and then before the VCs come along and invest, and you blow the S automatically, you can reorganize the corporation into a C corporation. You can set a C corporation down below with an F reorg, or you can just drop the assets down, start over. But that's like you start the clock over.
Yes.
Right. So you go from S to C, and it's another 5 years from when you started.
Yeah, and we'll get to in the next slide talking about how holding periods tack on. In this case, if you convert from an S corp to a C corp, it doesn't. If you go from an LLC to a C corp, it also starts at that point of conversion. Correct?
That's right. Now it's like it's a pure argument. You can use LLC holding period, but I think the standard approach is you convert the LLC to C corp. That's when your 5 years starts. And so for a lot of people who are in this AI space, we talked about this before, right? Like people are selling after 2 years or 2.5 years. So if you're going to try and start as an LLC and do the 10X, you got to really make sure you have enough runway. You can do the 1045 on the other side, right? But it's.
By the way, I would encourage you, if you're able to kill it as a founder and you're able to build a incredibly valuable business in 2 years, don't slow down.
Right. Don't
we got other tax solutions for it.
Drag the dog. Right? Just kill it. Yeah, that's right.
Yeah. Now, qualified use of assets. This is, in most cases, I don't think this applies. Actually, I see this most applicable for rollovers, where the whole idea is that you raise X money to build this company, or you have to use the assets and the money, assets or money. I'm using these somewhat interchangeably to build the company. You can't just be a passive holding entity. Right.
Well, but it's also got to be a qualified trader business, right?
Yes.
This number 4. This is the reason I have a job, right? This number 4. This is like basically all I do is think about this, right? Is this qualified use? And what this is actually a super important. This bullet point is important for 2 important reasons. Because what this rule says is this is the 80% test. It says for substantially all the taxpayers' holding period, 80% of the assets have to be used in a qualified trader business, right?
Yes.
And that's super important because what it says is for substantially all the taxpayers' holding period, right? People come along and they're like, hey, am I QSBS eligible or not? Is the company QSBS eligible or not? And that's framed the wrong way. You have to say for each person, like the founder, the early employees, the investor, we got to really test for each person about whether for substantially all that taxpayers' holding period, 80% of the assets were used in a qualified business.
Yeah, and to be fair, there's a lot of companies where it's kind of clear for most. I'd say most traditional SaaS companies, really, and we'll talk about this in a little bit. Is a lot of it's fintech and medtech is where a lot of this gray area comes from. So and we'll just go into the next piece here. Now we talked about the eligibility of after September 28, 2010. It's 100% exclusion versus the 75%, and then before that it was 50%. Now, bases and transfers. This is kind of mentioned the rollover period. If you convert from an LLC or S corp, your 5-year period starts from then. Now, when you contribute this property, the QS, if you contribute assets, if you go from an LLC that's worth $50 million, then your basis is 50 and you get the 10x that basis. Now, to preserve this QSBS status, let's say the most common, and this is really powerful for QSBS stacking. Let's say you've held the shares of your company for 4 years. And Chris, this is coming up to your question. Say, how far in advance do you need to plan? Let's say you've held the shares for 4 years and you want to do QSBS stacking, or you want to, for estate tax purposes, move these shares outside of your estate. Let's say I set up a type of trust that is its own taxpayer, non-grantor trust, or and I gift it to those trusts. How long does the trust need to hold those assets to be QSBS eligible? Does it need to hold it for 5 years from that transfer period, or just the additional year to hit the total 5 year?
Yeah, it's 1202H4 says that when you make a gift of QSBS, the recipient of the gift steps into your shoes for holding period, right? So if I'm a founder and I got my initial stock at the beginning, and at year 4, I set up 2 trusts for my 2 kids, those trusts that I set for my kids only have to hold for 1 year more each, right? Their holding period is tacked onto my holding period.
It continues. It's a continuation rule, essentially.
Exactly, right? And so we're going to get into this more, like the stacking. Now, like this question about timing, right? So there's a few important considerations though, because by the time I get to year 4, let's say we've raised a Series D or whatever, right? The company's super valuable. When I make those 2 gifts to my 2 kids, right? I have a gift tax issue, right? Like I've got to report the gifts to the IRS. I don't have to pay tax, right? But my spouse and I, between the 2 of us, we have about 30 million, 28 million, 29 million of lifetime estate and gift tax exemption where we can give away. So, in terms of timing, you got to think, well, ideally I give away the shares earlier when I eat into less of that estate and gift tax exemption, right? But I don't want to give away too early when, it costs money to set up the trust, all that other stuff. So you got to like gauge where's that sweet spot. Maybe after the Series A, if the Series B isn't too big, right around there, we find for most families, that's the time to kind of do the QSBS stacking because you're not using too much of your estate and gift tax exemption, right? For making those gifts. As we said, the QSBS 5-year holding period is going to keep going on, but the company's probably not going to fail.
Yeah, and I'd say the big.
Go ahead.
I was going to say the big trade-off here is, so it's early on. One, you're more uncertain, and typically you have less liquidity. The nature of these things is, right, like you're talking about ramen and that type of situation is you don't have a ton of liquidity as an early stage founder. And so typically one is you have, let's just assume you have a personal $10 million exemption. So one, you typically want to take that. And then there's also a personal question of depending on how old you are, or maybe it's like your kids. One, if the younger you are, you may not know how much money that you need or want to keep. If you want to gift it to your kids because they may be younger, you may not have kids yet. So there's more uncertainty. One, you don't know how much you need, or if you want to gift it to your kids, which is like this tricky balance but on the other hand, the longer you wait, the higher the value of your shares come. And you have what's called, you have a lifetime gift exemption. And so the more valuable your shares become, the more of that exemption you'll use up and potentially open yourself to taxes. So there's this trade-off between kind of like uncertainty of like how much you want to keep and how much you feel comfortable gifting to your kids, and having a low value, so having more flexibility with how much you can gift and avoid estate taxes versus more certainty on what you want out of life, how much you want to give to kids, and the value theoretically being higher. So it's a tricky,
and you don't know how much stacking you have to do. If you start gifting in year 3, like, do you really know how many buckets of 10 million you're going to have? Right?
You don't know how much the shares will be worth. That's
right. You don't know what it's going to be worth at exit. And I mean, my philosophy on the QSBS stacking has kind of changed, where we used to really encourage founders to set up as many trusts, like set up trusts for each of the kids and kind of maximize that. But increasingly, the founders who are going to exit for say like 40 million, that's where I really try and push them to consider closely whether, because if let's say you're going to exit for 40 million and you have 3 kids and you set up 3 trusts, you're giving, like when you do that QSBS stacking, you got to give it away.
It's not your money anymore. This is not your money to spend or control. Yeah.
Right. And you can't go out and buy a Maserati with that money. Like that's theirs. Right?
Yeah.
And so in that hypothetical, I pay 0 federal income tax, but I've given away 3/4 of my wealth.
Yeah.
Right?
And so yeah. And this is where sometimes it's like, it's weird because we both work in the tax space. You don't want to let the tax tail wag your dog. You want to fundamentally think of like, one, how much do me and my spouse want for our lifetimes? Do we have an idea of how much we want to give to our kids, right? Like when we want to give it to them. And these things, they can be hard. The older you are, I think it's probably a little bit easier, but particularly when you're young. And one of the things about the tech industry is you're seeing more wealth created earlier in life. And so there's less certainty in terms of what you want out of life, what that means from a financial standpoint. Your kids are young. Do you want to give them this money? There's all these things that are a little bit harder to answer. So short answer though is on QSBS stacking is there's a kind of optimizing this from a financial standpoint, which is, or here, I'll give you a very tactical answers. You need to, if you want to do QSBS stacking, you have to gift the shares to a trust or another person or entity before you agree to sell the shares. That's a very tactical thing of, if you've agreed to sell the shares, the IRS is going to tax you. If you gift it away before then you can get additional exemptions and get QSBS stacking. Before that time when you gift it is like these trade-offs of, the kind of the personal versus the financial and that type of, where there's no perfect answer, I'd say. But typically what I see is people want to get their comfortable on their own financial standpoint first before they start to do gifted outside of their estate to kids.
Right. That's right. That's right. Like plan for yourself first, then
Yeah.
and then do the rest of it. So if you're going to sell for 100 million, do the trusts for sure for each of the kids. If you're going to sell for 50, 40, right? Part of this as well is like building a good team, right? That most founders, you got to make sure you have a good CPA. You got to make sure you have a good financial advisor, all those things, like work with somebody like Manny or me, like whoever, right? Like there's people who are super sophisticated in this space that can help you think through the problems. There's not like a one size fits all.
Yeah, exactly. You want a framework to think about these things because your answer is going to be somewhat unique, but you need to understand what those trade-offs are and how that fits into what you want.
Can we talk about, like, because we are just going to go off into these rabbit holes. Let's talk about this tax-free exchanges. This is super cool, right?
Yes.
This is again 1202H says that if you exchange QSBS for non-QSBS, you can preserve your QSBS shares and your holding period keeps clicking along, right? So assume that I'm a startup founder, right? And I'm at year 3, okay? And Microsoft comes along and says, hey, Christopher, we want to buy your shares for $10 million and we'll give you all cash or we'll give you Microsoft shares, okay?
Yes.
If they give me all cash, I'm at year 3, I got to do the rollover or whatever, right? But in contrast, if we do a tax-free merger, right? This is the tax-free exchange, where in year 3, I exchange my startup co-shares for Microsoft shares. 1202H4 says those Microsoft shares become QSBS up to the $10 million merger consideration. And so I can ride out the clock in the Microsoft shares. So I've totally de-risked, right? And then at year 5, let's say the Microsoft shares have appreciated to 12 million. The first 10 million of them is QSB. I sell, I can exclude, I got to pay tax on the delta. So this is for founders thinking about the deal structure. That tax-free reorganization is unlocked a lot of
cash is not sometimes king is another way
right.
that cash is. Right. So another very related thing here is QSBS. So this is tied to QSBS rollovers. That's the essentially you can preserve the exchange. Now another common piece is you're getting bought by another startup and you're getting bought when now. So okay, well, there's 2 scenarios. If you get bought by another QSBS eligible company and at the time of the acquisition it's eligible, if you're 3 years in, the clock keeps going. You just need to hold those shares that yours are exchanged for 2 more years. But then there's the scenario we're seeing more and more, whether it's AI or just more broadly, is people have held their shares for 2 or 3 years. Now, your options are, it's because your shares are QSBS eligible, but you haven't hit that holding period. Your options are 1, you can pay the tax. So pay, potentially up to 35%. You can use like a tax deferral vehicle, like a general rate of trust to defer those taxes. Or there's QSBS rollovers. Do you want to kind of explain what that works and kind of like what the limitations are there?
Sure. Yeah. So we were talking about this Microsoft hypothetical. That's 1202H4. There's a whole separate code section, section 1045, right, which is a tax deferral, right? 1202 is the exclusion provision. It says you hold for 5 years and sell, you can exclude. 1045 is deferral provision. It simply says if you hold QSBS for all you got to do is hold it for 6 months. Once you've held the QSBS for 6 months, if you sell it and reinvest it in other QSBS, then your holding period keeps clicking along, right? Yep. So theoretically, like the hypothetical is, I sell my company at year 3, right, for $10 million, all cash. So as Manny said, absent doing anything, I'm going to pay long-term capital gain. But if I take that 10 million and I invest it in Manny's startup, right, I only have to hold those shares of Manny startup for another 2 years. Then I'm out of the 5-year holding period. And I can, then when we sell, I can exclude again. Now, Valur is awesome, right? But most people don't have a cool thing to invest in, right? So oftentimes we'll see founders who sell at that point and they set up their next startup, right? You roll over, you essentially can become like a big angel in your next startup. And so that's kind of nice that you unlock that possibility. Of course, it can't be, it needs to be, you can't just be holding the shares again in 5 years. It can't be a sham corporation or something like that. You got to show.
Yeah, and this is the active business. We're talking about this, the 80%, right? Like you can't just park the money in a new company.
Right, you can't go buy real estate or do stock investing. It's got to be like your legitimate next company.
You're taking risk. Yeah, again, QSBS, the fundamental premise is it's encouraging people to take risk, knowing that there's risk to increase the upside. Now, I can tell you, this has come up a bunch of times in the last week last couple of weeks of founders who are in this situation. And it's interesting if people are trying to, whether it's AI or companies just where they are, people are exiting, they have eligible shares and they're exiting before the 5-year mark. And they're getting approached by a bunch of, the downside is, to the point of, let's say you're a founder, you've exited in 3 years. You want to roll it over into your next company. Now, the downside, by the way, is, again, we're going to keep on saying this, don't let the tax tail wag your dog. Startups are risky. Like hopefully everyone on this webinar knows that. The risk is if you roll those funds over, that could go to zero, right? And so that's fundamentally the risk there. And so instead of just thinking about the upside, you want to think about that. Now, people have been trying to pitch of, that you can, there's different types of investments. And I guess broadly is, we're not talking about specific ones, but fundamentally it's like, if it's pitching kind of like a real estate or a lower risk model, is there some risk that's not actually going to be a kind of a eligible QSBS rollover?
Yeah, I mean, it's got to be like a legitimate new startup or building something, right?
Yeah.
If the rule says that, and we want to get into this 1202E category, right? Like a qualified trader business can't be in certain industries, like service industries. We'll get into this. It can't own more than 10% stock or securities, and it can't own more than 10% real estate, right? So you can't just de-risk and roll over and put the money in like real estate, right? It's got to be like another legitimate startup where, as you say, Manny, there's risk, right?
Yeah.
And you're trying to really build something.
And this is probably one of the areas that you've, again, have gone deeper than anybody and kind of pioneered a lot of where there's a lot of gray area, right? So it's like, just this qualified trader business. The whole idea is essentially it's investing in risk areas. QSBS excludes service-based fields such as law. So unfortunately, your equity in your law firm doesn't count for QSBS.
Right.
Health consulting, finance-related industries. Finance-related is a very interesting and vague term. Farming, hospitalities. And so maybe you want to talk about, you've particularly had a lot of with finance-related, we've seen a lot of, fintech has been a big area of growth over the last decade. Like what is counts as finance-related versus tech in this?
I know, it's right. Okay, so this is 1202E3. This is, and as I said before, like this is why I have a job, right? Is that Congress did a terrible job in drafting the statute, because if you read 1202E3, it tells how you get QSBS only in the negative, right? In other words, it says, if you want to get QSBS, you can't be in any of these 20 industries: health, legal, accounting, financial services. Manny's listed a bunch of them here, right? So they only tell you what you can't, right? Not what you can. Now, and so, financial services or banking or insurance are all listed categories. And if that's a blanket prohibition, then every single fintech in Silicon Valley doesn't get QSBS, right? And what's nice is that I think it's a little more like subtle, the way the rules work. The IRS has issued a series of pieces of guidance going back to 2014 involving health companies, a couple of insurance companies in the consulting industry. And when you kind of read all that guidance and synthesize it, what the IRS was really trying to say was, we don't want just service industries like bankers and lawyers and doctors to get QSBS. But if you're building something in one of these spaces, you can get it. So like there's a 2014 private letter ruling involving a pharmaceutical company. And the question was, is this pharmaceutical company in the health field? And the IRS ruled that it was a qualified trader business, even though it was in the health field. And the language, it says something like, this company was using its manufactured assets and IP to add value to its customers' lives. It was the analog of a parts manufacturer in the automobile industry, right? So if you're like building something in one of those fields, right? So again, like take this example, that I'm a lawyer, so I don't get QSBS, but let's say I build an app, right, that says put in these data points, and this will kick out whether it's QSBS. Is that tech, right? Have I built an algorithm that delivers this? Is that legal tech or is it law, right? It's right on the edge. But the
whole point is making things better, right? Innovation, right. And right, like that's it. And this is where there's been we don't have to speak to the civics, but I remember when I was first looking into this, there's been a lot of fintech banks, right? We've seen the neobank as a category, right? And if you just read the word finance related, you don't think they do. But then you think about, what to say, SoFi or Chime's about to, I filed their S1, so they're probably IPOing in the next 6 months, right? Like, I think, they're a bank, but then fundamentally what made them different from JP Morgan or,
Right,
those.
right. Yeah. And all those guys, because like I've worked with lots of these folks and they're all engineers, right? They're not bankers. They're not stockbrokers. These guys, what makes a fintech company or a neobank is like they were going in to try and solve some unique problem, right? Like easy access to capital or whatever, right? Like take the insurtech companies, right? Like those insurtech guys, they designed algorithms that'll go through and like isolate why me. So I have a terrible FICO score. Don't tell my wife. I have a terrible FICO score, but like they've been able to go through my LinkedIn profile or whatever and say, oh, well, Christopher is a lawyer, and therefore we're willing to insure him or whatever, right? Like they designed better ways to deliver insurance or better ways to do banking. That's like fundamentally what QSBS is about, right? You said this, right? Are you building a better mousetrap? That's what, I think if you see what you're doing is building a better mousetrap to solve some problem and be disruptive, that's fundamentally QSBS.
Yeah. Now let's move on to, there's another, and I know there's a bunch of questions, but just for timing, we'll get to, so what's QSBS stacking? Maybe you want to give kind of an overview of what is QSBS stacking and kind of what does that mean? You referenced there's a New York Times article, and this is where it's QSBS, you mentioned this over the last decade. QSBS has kind of been from this niche, joking about kind of being for tech bros to, it's on the front, it's a headline for the New York Times. They're talking the impact of this. It's gone from a 50% piece under Clinton to Obama making 100%, and it's been a broader kind of boom of tech is as big a percentage of the American economy as it's ever been, right?
Yeah.
And so it's, obviously, we don't want to say that's due to QSBS, but it's playing a more prominent role and there's more value. So more people, there's more value. You have a $10 million exclusion, which sounds like a lot, but what is QSBS stacking?
Right. Well, we talked a little bit about this before, right? That 1202H4 says that if I have shares at QSBS and I gift to another taxpayer, it's got to be a gift, right? Then that taxpayer steps into my shoes for holding period, for original issuance, for all those other requirements. And what this unlocks is, you said this at the beginning, the rule says each taxpayer can exclude the greater of 10 million or 10 times his basis in each qualified trade or business. So if I'm a founder and I'm going to sell for 100 million and I've got 9 kids, I could theoretically set up 9 non-grantor trusts for all of my 9 kids, right? Plus me. We pay 0 federal income tax. This goes back to this issue that we talked about before. It's like, you really want to give away everything, and you got to give away. But what's stacking unlocks? It's
a separate question, yeah. Right. If you're just focused on just the tax implications, right? That's the
right. And if you're giving away 90 million to your 9 kids, you probably should if you had 9 kids, right? You don't have time to. So that's what QSBS stacking does is unlock this ability to kind of multiply the exclusion over various taxpayers. And this has now become pretty standard in the Valley for founders who are going to exit, to set up trusts for their kids. There's an open question about whether husband and wife get 1 bucket of 10 million or 2 buckets of 10 million. I think people come in both ways on that. But theoretically, if 2 founders started out and they each got the shares and then they went along and later got married and sold, I think there's pretty good arguments that those sort of situations you could get 20 million between spouses.
Yeah, and there's definitely some also gray areas. So it's like, the common ways you see is people use a non-grantor trust. So you do this for each kid, right? This is there's kind of this joke I've probably heard too many times. The reason Elon's having so many kids is he's got a lot of QSBS exclusions he's got to catch up to, right? Like for each of his companies, he could just keep on stacking that. But people typically set up again, ignoring if you want to gift it to your kids, let's assume you do. You can set up at least one trust for just your kid, one non-grantor trust for your kid. You could set up what's called a SLANT or spousal lifetime access non-grantor trust that includes your spouse and your heirs. And then we'll a lot of times see founders set up CRUTs that go back to themselves.
I wish you'd talk about this, Manny, because like this is, from my perspective, again, like I'm not a T&E guy. I'm just like on the income tax, like the CRUT and the CRT generally is like the most elegant solution. Like it unlocks QSBS and it unlocks like philanthropic planning. Like it's such a good way to, because it does all the things you want QSBS to do, right? It gives you more QSBS, but it also starts to, for a lot of these guys, like philanthropy is going to become important.
Yeah, no, totally. And this is where it's like, if you're doing a ton of stacking, there's probably at some point where philanthropy is going to become a bigger part of your life as you get older, your focus shifts away from the business. And so kind of just to give a kind of quick overview here, right? So you have QSBS stacking assets, right? Like, so let's say I have 20 million. I can only claim 10 million for myself. So one option is I could give 10 million to Christopher. And guess what? Because he's a different taxpayer, that second 10 million, he could sell and claim QSBS. But because he's in California, he only gets at the federal level. He doesn't get at the state. It's very simple, kind of elegant from that perspective. Another option is I could set up a non-grantor trust for my kids or heirs. And one benefit is that moves it outside of my state. So then because it's for my kids and heirs, it's a different taxpayer. They get their own $10 million exemption, and that 10 million grows a state tax free. Now, there is a great...
And also, the non-grantor trust, like, for example, when we do it, we'll set up in South Dakota, right?
Yep.
So for
we do the same thing.
For California founders, then you can actually avoid the 13.3, which is kind of like a nice added.
The state tax. Yeah. We do the exact same piece. Now, interesting, there's a bit of gray area of, so let's say you have one kid, or let's say you have two kids. You have two kids, you set up a non-grantor trust for each, they're the sole beneficiary. There's a gray area where if you set up a non-grantor trust for each kid and all their future heirs, does that get its own exemption? Now, I typically see, I'm curious as to kind of where you see that landing for folks.
Yeah, well, I don't know. I mean, like again, I'm not a T&E guy, but you know, we see people will set up these pot trusts that can subdivide into multiple trusts. I think there's a variety of issues. I think the real question more is like, do you have enough beneficiaries to can you justify, like, and there's like 643F, there's like this idea that the IRS will collapse trusts that are too similar. Yeah. I think if you just say, like, this is all, like, I have 4 kids or 2 kids and 2 parents or 2 in-laws, whatever, like, as long as there's somebody at the end of each of these, it's going to get his or her own bucket. I think it's okay.
Yeah. And then this is where, and this is the piece of, like, if you have grandkids, things like that, it becomes easier. Now, Peter, for this California resident, if you set up a non-grantor trust in South Dakota, etc., the default we see is we set them up in South Dakota as well. The default we typically see South Dakota and Nevada as kind of the top 2 locations. You gift your shares to that, then you're able to avoid those are now owned by the South Dakota Trust, and that is the taxpayer. And California isn't going to be taxing those. So that works for non-grantor trusts. Slats. Now, to call out slats here, this gives your spouse access to can take distributions from the trust. So with the non-grantor trust, essentially, again, you're giving away that money. It's for your kids or for your heirs, future generations. The slant, your spouse can at least access it. The CRT, what Christopher was mentioning, is this is a trust where in most cases, you are actually the beneficiary of it. You're what's called the income beneficiary, and you're entitled to roughly 90% of the benefits. It's typically a little bit higher. And then there's a charitable beneficiary, could be a donor advised fund, your own foundation. But essentially, typically over 5 years, the proceeds from those assets are QSBS eligible and get distributed back to you. And then roughly 10% goes to the charity of your choice. And the idea is it's a way to stack exemptions and keep more liquidity for yourself and philanthropically give. That's kind of the typical strategies we see. The downside of CRTs is it's inside your state. So good news is you have the liquidity. Downside is if you're worried about estate taxes, it's not a great fit for that. And we'll just kind of, in the interest, and we'll get to some questions after this. Here's kind of a simple example, right? Is startup founder from New York. You have 3 kids. You set up 3 non-granted trusts in South Dakota, and you have $50 million of shares, and you set up a CRUT. You keep 10 million for yourself. You give 10 million to each non-grantor trust in the CRUT, and the shares sell for 50 million. If you do QSBS stacking, you're going to keep roughly 50 million. If you don't and just kept it yourself, you keep $36 million. Right. $14 million difference, obviously pretty substantial.
Right.
Now,
right. Of course you do it. It's some stacking. Right.
Yeah, of course. Now, here's the thing is compounding is one of those things of, the 8th wonder of the world. It's 14 million now, but if 25 years and growing at 8% a year, that's more than $60 million difference. So this is also, it's substantial now, and it's even larger in the future. We'll get to some questions because quick overview. I know, first of all, I want to thank Christopher for joining, kind of a wealth of knowledge, the expert in the space. You can reach out, particularly, do you want to give kind of who you typically work with? I know you work with a lot of companies that are kind of in this are we eligible? There's a couple people who've mentioned as part of your company is eligible, part of your company isn't, but maybe give a brief overview of who
we
you
work with everybody. Well, most of our work comes kind of midlife cycle where we'll analyze the company, but a portion of our work comes kind of midlife cycle. People are starting to think, oh, maybe it's QSBS. And so they'll call me and we kind of analyze companies. But most of our work is at the end, like planning into maximizing QSBS, right? So working on trust. And then once they sell, oftentimes founders will hire me to write tax opinion letters to say, hey, look, we've analyzed this fintech company, whatever it is, and they qualify. We'll pick up the trust with the stack and all that stuff.
Yeah, and by the way, I'd say just people may not be familiar with the tax opinion letters. Effectively, you can think of it like insurance. If the IRS wants to disagree, a tax opinion letter is a form of protection against the IRS deciding that they don't like what you did.
Exactly.
Just a quick, what we do at Valur is we help people set up these we don't go to the level of depth that Christopher does in understanding or evaluating these companies. If you're looking to set up these QSBS stacking structures, we set those up and administer those. But we'll jump to, you can feel, we have our emails on here. We'll also send out a copy of this webinar afterwards, so you'll have all these resources. But we'll jump to some questions. So half of my company is QSBS eligible and the other half is not. Let's just assume it's a C Corp. Can you still get QSBS treatment at the sale here?
Question, right? Like okay, so this is like every day we're talking about, the answer is, I don't know. Like, why is it half? Is it half because half the income is getting, or like half the income is getting generated from insurance sales, right?
Yeah.
And the other half's not, like what, so the IRS doesn't give us any good guidance about how to determine whether you're in the insurance business or in the insurtech business. Our position generally, and I think most people kind of agree, is like, hey, look, where's the real value in the company? Is the real value in the technology? Are you going to go raise a bunch of money from the venture capitalists? Like raise 10 million on an $80 million pre-money value? Like, that's technology. Yeah. And so I guess the question would be, what does that half mean? Like, half is eligible, half is not. It's important to think through how you're valuing the company or valuing income flow streams. But what's good and bad, good for me, but bad for founders, is that we don't have definitive guidance about how to interpret that. It's a real good question, and there's not. Yeah. My thought is like, take a position that's reasonable. Don't be super aggressive. Think through, if the IRS looked at this transaction, how they'd approach it.
Yeah, and by the way, we kind of hit on this. Like, what important piece of law is this QSBS section 1202, is a really poorly written thing by the IRS. And there's two sides of this. You're kind of joking this gives you a job. First of all, you'd have figured out another like great niche, but like the other part about this is the IRS tends to not actually be very aggressive because, one, they're not sure where they would land and whether it actually open up more downside for them. So the IRS, it's not a historical area that they've been very aggressive. It's been brought up more in the last couple of years. It's also become more of a political topic. I think Schumer a few years ago brought up eliminating QSBS or reducing it down to 50%. So it's become more of a political hot topic, but it's currently so poorly written that it's a double-edged sword as to like, you're not going to have perfect clarity, but the IRS also doesn't have perfect clarity, and they aren't very aggressive because they don't know if pursuing this would actually.
Well, that's right. Well, it's going to open up this huge can of worms that everybody gets QSBS.
Yeah. Now going to this other question of, so there's considerations of moving to a conforming state. So you're in California and you have QSBS eligible equity. Like, let's say you want to gift it to kids. The simple thing is set up a non-grantor trust in South Dakota. You gift it to the trust. The trust is now the owner. And then 6 months later, you agree to sell the company or those shares. Like, you're fine there. Now, but let's just say you want to remain the owner of those shares.
Right.
This is and maybe this isn't the right question for you on the T&E side. A lot of this is also tied to the state. Different states have different rules around.
This has nothing to do with QSBS, right? This is about, are you a California resident or not? And
yes,
as far as Gavin Newsom is concerned, it's that Eagle song, you can, like Hotel California, you can never leave, right? Yeah. That's California, right? California, if you think you're going to leave, like, as we have a lot of discussion with founders who are trying to do stacking and whatever else, and then they think, well, I'm going to move to Miami, right, to avoid California tax. And you got to be really thoughtful. You should really leave a whole calendar year before. But it's just hard because
so typically we've heard 2 years. Typically what we've heard is you want to
2 years. If you can do 2 years, for sure. But again,
and then you don't want to move back to California within 2 years. The thing we've heard is you want to leave 2 years in advance of your sale, and then you also do not want to move back to California within 2 years of your sale. So again, they do not want to see that this is a transactional move, right?
California, the rule in California for residency says you have to establish residency in another state, and you can't have the intent to return to California. So if they can show that you just moved to Florida solely to avoid tax, your intent was to return, you don't establish residency in another state.
Yeah.
So that's like there's like so many fact specific questions on residency. I think if you're going to do it, do it. But as I say, like 2/3 of the time we're talking with founders and I'm like, oh, great, you're going to sell your company. And they're like, yeah, I want to move. And I say, well, okay, so how, like, are you going to move your kids? They're like, oh, no. The kids are going to a great school in Palo Alto. We're just going to stay here. I'm like, you're not establishing residency in a new state.
Yeah. You need to, I mean, I don't want to say commit to the bid in like that sense, but you need to be committed to the move. I mean, I've heard everything from lawyers telling people to move to like be very vocal on social media platforms as to why you're moving, that this is a permanent thing. Like you want to show that this is permanent. And like, I'm not saying Twitter is very performative in many ways, but like, I'm not saying that's the answer, but like, this is something that should be a permanent intention and at least should be perceived as a permanent intention. And you shouldn't, kind of just move back right after.
Yep. Exactly.
And I think we kind of answered this, but to stacking it, if you stack your trust in a non-granted trust in a conforming state, it does, if you gift the shares to that trust, it does prevent California from taxing your QSBS gains. Now, the obvious follow-up question is saying, hey, if I move from, since I moved from San Francisco to Miami, and then why is that not kosher or a little bit risky that California can tax it? But then if I just gift these assets to a trust in South Dakota and 6 months later sell it, like, why is that kosher? And I guess the simple answer is when you move to Miami, you still own the shares.
That's right.
Guess what? The trust now owns the shares. And again, this is the downside. You give these shares to the trust, you are no longer the beneficiary of those shares. And so that's the key thing to keep in mind is who is benefiting. The trust is benefiting. It's a South Dakota resident. If you're benefiting as a Miami resident, but previously California is going to say, hey, maybe that is part of ours.
You got it. And so that all this, you got to be super thoughtful about all this stuff. You said it, right? Don't let the tax tail wag the dog, right? Do good QSBS planning, but you don't have to save everything.
Yeah. Just want to say, I know we're a little bit past time, but Christopher, want to thank you for joining, and I hopefully it was valuable to everybody. And I just want to say is, if you have questions, feel free to follow up, email us. We'll send out follow-up content with this webinar, as well as some tools some content to better understand QSBS and some of the options available for QSBS stacking, etc. So, and thanks everyone for joining.
Thanks, man.